we are replaying 317. The day before, on the 16th, the market put in a new low relative to the recent break. The market closed off of the low on that day with overnight inventory being long. So you see where the settle is. The settle is at the 2405 level. And then you see the market, most of the overnight inventory was higher. The inventory overnight was limit up at one time. Then it sold off limit up. Limit up for futures overnight is 5%, whether it is up or down. All right, so the market has opened or is going to open shortly. And as we know, overnight inventory is long. With overnight inventory being long, the odds are that we will have a counter auction. A counter auction to long overnight inventory would be selling. Okay, so the market is open. We are right near the point of control from overnight, which is also about where we opened. When you open within a previous day's range, that is a form of balance. When you open within a previous day's range, the odds are that you're going to experience chop. Chop simply means that the market will trade back and forth. And what happens if you don't understand that we're in an atmosphere that could be very choppy, you can get caught up both financially and emotionally. And that's why you want to avoid chop. I actually think being caught up emotionally is more important than being caught up financially. All right, so now we open. We're within the previous day's range. Market open, it's traded a little lower, traded a little higher. Now we're back up, and as you can see, we've traded through the afternoon rally high up there. Just went through it a little bit. So the markets chop, we're back lower, and a lot of volatility. Remember, volatility has been running exceptionally high, sometimes in the high 70s in this market. And to put in perspective what kind of volatility we're doing here, volatility on the low side over the last 10 or 11 years ran around 11, 12%. Average volatility is probably 16, 17, 18% range. Recently, we've got up into the 75% range for volatility. 75% range in volatility equates to approximately a 4% swing on any particular day for the E-mini. So it gives you some idea of the volatility. So we've opened, we went lower, we went higher, now we're testing back lower. And remember, overnight inventory was long. So we are getting a counter auction relative to overnight inventory. One of the most misleading situations we deal with is when we get a counter auction relative to overnight inventory or a correction, and we mistake that correction for real selling, when all it is liquidation of existing inventory. Okay, so we went back down through the settle of the 16th. Market looked below the settle, did not find additional selling down there, got a little bit of a bounce, but with this volatility, we have to give it a little more time to see. Our next downside reference, of course, would be the overnight low. The settle is always an important reference. And then, of course, we have the previous low of 316, which is down in the 2350 level. So currently, we're still within the overnight range, as well as being in the range from the 16th. As advertised, we are seeing chop. Right now, you may say, well, wait a minute, the market's going straight down. Well, but remember, we opened, we went lower, we went higher. Now the market's working on the downside, but it still qualifies as chop. We are still within the previous day's range. So trading is about change. We have seen no real significant change. We're seeing volatility, But when you're within the previous day's range, and particularly also in the overnight range, there's no change. There's volatility, but no meaningful change. No meaningful change increases the odds that we will continue to see chop. Okay, we are playing at 3 times normal speed. We are only about 12 minutes into the morning. So let's speed it up to about 10 times normal speed. So remember, we're playing at a much higher rate of speed than you'll see in the morning. That makes the volatility even look, more aggressive than it is. So the market's trading lower. We're 15 minutes into the day. We did not take out the overnight low. See the market rally, we're back up near the settle. Through the settle, see the white line coming up, that's half back. That white line at 24.15 level, that is a important reference for short-term daytime frame traders. Other traders don't even know where that is. Investors don't know where that is. That's something that is, in the domain of the daytime frame short-term trader. Okay, so the market went up just below half back, and the sellers came in again, pushing the market lower. One more time, trying to get down to the overnight low. Pushing pretty hard, but keep in mind, as hard as this feels, we are still within the previous day's range. So we've taken out the overnight low. Market is testing down to the low of the 16th, or the low of the previous session. We are still within the range of the 16th. Remember, we're playing at 10 times regular speed. We're going to change time periods very shortly. Right now, we're in the first period, A period. Tremendous volatility. It's consistent with what we've seen in the market. Market goes back low. B period goes down. Tests the low of the 16th. Doesn't quite get it. Comes back up in the overnight range. So volatility is still very high. B period did take out A period on the downside. It did not take out the low for the previous session. These are extremely difficult markets to trade with this kind of volatility. It helps considerably when you can calmly understand we opened, we went lower, we went higher, we went lower, we took out the overnight low, but we are still within the range of the 16th. When you are still within the range of the previous day, you expect rotation or chop. Okay, so the market is back up above half back. Last time it got just about to half back and the market sold off. So this time we came back through half back, and notice just above half back is also the settle for the 16th. Now let's stop here for a second. Let's kind of review what can happen at the settle. There are an awful lot of short-term traders. And I have been in rooms, people, hire out a desk in a room and it may be filled with many traders. And the sophistication level in those rooms sometimes is as follows. Oh, the market's green, which means we're above unchanged. The market's red, which means we're below unchanged. I know that sounds silly, but that is kind of what happens. When it's green, traders tend to get really excited and they start to buy it. When it's red, they get excited and sell it. Now that's not everybody, but that's an awful lot of short-term traders. That's the extent of their research. And a lot of this is because they are price followers. What is important as we go through a day like today is that you learn to focus on the references. Some of the references we've seen so far, we saw the settle a couple of times. We've seen the half back for the first half hour. We saw the overnight low, and we saw the low from the previous session. If you are working and training yourself to see price, but see price in relationship to those references, what will happen, or what should happen, is that you will become calmer and you won't be as emotionally captured by the volatility of the market. And that is extremely important. Market understanding and self-understanding is the combination that will make a successful trader. And many times successful traders have to be able to control their own volatility, or put it another way, their own emotions. All right, let's go back and play. So we're back up to the settle, and we know that the settle is another short-term reference. The settle is also right around half back for the early morning range of the 17th. Value, when we look at value, now it's too early, but value is building overlapping to lower right now. That can change. Okay, we're back above the settle. So we've been back and forth through the settle multiple times. What does that tell you about the overall confidence of this day? When you are backing through the settle several times and you're within the range for the previous session, it tells you that overall confidence is low. Now that may change throughout the session, but right now the overall confidence is low. And that is an important observation to make, because it helps you not get too carried away on the short side or too carried away on the long side. And that being able to control your emotions is extremely relevant when you're talking about being a successful short-term trader. All right, we've got just a little bit of time left in B period. So B period did take out the A period low. With B period having taken out the A period low, I start a new period, or a new profile with B period, and what I want to see is, does the market one time frame higher after taking out the A period low but coming back in? So the B period low, now we're in the C period. We are back above half back. We are still within yesterday's range and within the overnight range. The market is coming back up towards the prominent point of control from overnight. The more prominent a point of control is from overnight, the higher the odds are that it will be revisited. Now, people ask, well, what is prominent? I don't know the exact answer, but it will stick out and it won't be that difficult to see. All right, now, let's stop for 1 second. What is important for you to have just observed is that the C period low is just a tick above the settle. Now, that's only one data point. It may remain, but it is not a strong. The C period low would be considered a weak low because of its exactness to the settle. Now, that affects odds in 2 ways. It lowers the odds that the market will have continued expansion to the upside, and it increases the odds that we will come back down through the C period low. So there's 2 effects. By having a weak low, it can have 2 effects on the market. What is most important is that you notice it. If you don't notice that, you're missing a vital piece of information, and it means you're also too busy following price in order to get a different, larger perspective of what's really going on. So the larger perspective in what's going on, we opened within the range from the 16th. We opened within the overnight range. We took the overnight range out, but we're still within the range for the 16th. When you're within the range for the 16th and you open in there, and now we're going in, it's a little over an hour, the odds are that the market's going to be choppy or rotational. Rotational meaning back and forth. Those are important observations. When a market is rotating back and forth, you're looking for smaller opportunities, but more of them. Okay, let's continue to play at 10 times regular speed. So notice the C period high isn't very positive either. It's just below the opening. So the C period high is mechanical, the C period low is mechanical. So let's stop for a second. Okay, we said just a little while ago, the odds were high that we would come down and take out that C period low. And we said that was high, that that would happen because of its exactness. So the pullback in C period was a tick above the settle, which makes it weak. And we said that does two things. It decreases the odds of substantial move to the upside for right now, and it increases the odds we will come back down through the C period low. We have just come back down through the C period low. Now, before we start to play again, keep in mind that the C period high is really nothing to write about. It is just 1 or 2 ticks below the opening. So when we stop this, the odds were good that we would take out both the C period low and the C period high. We used the word sequencing in talking about this recording. Sequencing is okay. If you take out the C period low first, then the odds suggest that your next look will be at the C period high. Does that sequence have to hold? No, but it's certainly a sequence for consideration. Let's go ahead and play. All right, but we'll continue to play. We're 10 times speed. Okay, and then above, if we do come back and take out the C period high in the opening, and then the next thing we'll be looking at will be the prominent point of control from overnight, and just above that is half back from overnight. All right, let's stop for a second. All right, so now you've seen that we have taken out the questionable C period low and the C period high. I've taken both, and we talked about the importance of sequencing. Okay, let's continue to play. So the next reference on the upside will be the afternoon rally high from the 16th. Even though we've been there once and we traded through it, it's still a reference that I continue to follow, because we haven't been accepted above the afternoon high. Unless we're accepted above the afternoon high, then there's no real change or potential for change relative to yesterday. You get accepted above yesterday afternoon's high, then you have a potential to change. Doesn't mean it's going to, but you do have that potential. And then you'll see just above the afternoon rally high is also half back from yesterday. Half back, whether it be overnight or whether it be the previous day, or whether it be this morning, are always relevant references. Half back from the previous day is a static reference. It's not going to change. Half back today is a dynamic reference because it will change as the market changes. And trading, as you remember, continues to be about change. All right, so we're in the C period. We're going to change to D period shortly. So you see we're still, right around the opening. The C and D period high are questionable. They may last, but the fact of the exactness still draws your attention to it. One more time, it is important that you not get mesmerized by price. You want to look at price in relationship to the references. Okay, so now we made the low in B period. So from the B period, B, C, and now D, we are one time framing higher. That may not last, but you can turn into a trend day once you've tested the low. All right, so the market, we've come back again through the afternoon rally high. We're looking at half back from yesterday. And of course, now we're going to be looking at the earlier morning high, which was part of the initial chop. Okay, so when the market failed to take out yesterday's low, then the destination trade becomes the opposite extreme, meaning the high of the previous session. Doesn't mean we have to get there, but it is just one of those things when you're saying, where could the market go? When you fail at the lower end, the potential then is to auction to the upper extreme. Okay, so overnight inventory was long. Let's stop for a second. Overnight inventory was long. One of the cautions that we issued, when overnight inventory is long and the market sells off to correct or counter auction relative to that overnight inventory, one of the biggest mistakes traders make is mistaking that overnight correction of inventory or counter auction for something more sinister or something more directional. And in fact, all you saw at this point in time was liquidation. So you want to be aware of that trap. It's easier to keep the perspective. If you remember that overnight inventory was long, you remember we're still within yesterday's range. So the odds are that you're still going to have rotation back and forth because there's been no real change so far. Okay, continue to play, please. So of course, the next upside reference, if we get there, would be the overnight high. And remember, at one time, the overnight high was limit up. Okay, now at this point in time, what I'm looking at, if stop for 1 second, put your cursor down where the single distribution starts above the A period high. So we could put a red line down there. Okay, so that marks the start of a new distribution. So what we're always looking for to see is, do we have a double distribution? So at this point in time, if there's strength in the market, that distribution will not be closed. In other words, we will not merge the upper distribution with the lower distribution. If the upper distribution gets merged with the lower distribution, that is relatively negative. All right, so right now it looks like the potential for a double distribution. And we can go ahead and play. The next upside reference, of course, is the overnight high, which was limit up. That would have been up 5%. So let's go ahead and play and see what happens from here. Okay, remember, we're still within the previous day's range. We're still within the value area for the previous session. So right now, as of right now, value would be overlapping to lower. So that is another area that you have to keep a close watch on. Okay, so the market backed off, has not filled the double distribution. And we're going to change time periods here very shortly. We still have a double distribution. We are still within the range for the previous session, and we're still within the overnight range. A lot of volatility. Remember, we advertised chop to start with, and guess what we've had? We've had chop. Think how dangerous this can be for traders that don't understand what we're talking about. We're getting what's expected. This kind of volatility in chop is what is expected when you open within the previous day. Okay, so D period, E period. We now have, at least at this point in time, let's stop for a second. Okay, we now have a poor high at the DE high, and it's a poor high because there are no single prints. And at this point in time, the odds are that we will take that out because it does not look like a completed auction. It's only one data point, but it's not normally the way an auction stops, and not on a situation like this. So at this point in time, our two short-term references, of course, are the print down at the A period high, which would merge the upper distribution with the lower distribution or close the double distribution, and the poor high that has no single prints. So right now the odds are that we take the DE high out first. If in fact that's not what happened, let's say for example that we then decide to go down and merge the two distributions. Now, where before we said if the distributions would merge, we said that would be negative. If the distributions were merged now, we have different context, and the context would be different now because we have a poor high or a high with no excess. So Sequence is important. What happens first? So if by chance we closed or merged the distribution, that changes the sequencing. Now it's no longer as negative as it would have been if we would have had a good or completed high. So let's go ahead and play. So we're still in the overnight range. Value's still overlapping to lower at this point. Still within the previous day's range. Still a lot of chop. And remember the importance of being able to see all the other things and not just focused on price. If you're just focused on price, you're going to miss some really important concepts. Okay, let's stop. So now what we said happened. So the distribution was closed first, which initially we said would be negative, but now because the context has changed, the odds are now that we will rotate back up and take out the poor high. Do we have to? Of course not, but it is certainly a consideration. All right, let's go ahead and play. But just think how hard it takes training to be able to see and make these observations, and then make the observations and relate to what do they mean. But I will assure you that if you can do this and watch price in relationship to these references, your anxiety level will go down considerably and you will be much closer to being in control of the market rather than letting the market be in control of you. Now, of the series that you're going to be looking at in this educational series, this is without a question the highest volatility that we've experienced. So, but what we have found, even though this happens very quickly, we have found that the same activity happens at all the references, no matter what the volatility. And I'd never traded volatility this high before. And it took me a couple of days to realize that, but it's amazing. All right, so now you've seen what happened. We did come back up and take out that poor high. So we took out and merged the distributions and did come back and take out the high. So the next reference, of course, now would be the overnight high. It's easy to see. Traders can see it, and it's likely there would be stops above that since that was, limit at one point in time. So the market is still overlapping the lower value, although the odds are changing because we're getting up near the high of the previous day's value area. Okay, so now we're going to change once again. We're going to go from E to F period. And let's stop for a second. Let's take a look at the E period low. Notice the E period low did not take out the D period low. So from B period made the low for the day. C period did not take out the B period low. The D period did not take out the C period low. E period did not take out the D period low. So the market continues to one time frame higher following the early low in B period that failed to take out yesterday's low. When it failed to take that out, the destination trade now becomes the opposite extreme or the high of the 16th. Okay, let's continue to play. So you can see that doesn't mean it's going to get there, but we use that to judge how the market is doing. Okay, so F period comes along and F stops exactly at the overnight high or a tick below it. Again, let's stop for a second. That would be considered a weak high. It's not a poor high because there are single prints, but it's a weak high because of its exactness or just a tick below the original overnight high. So once again, and this is only odds, but once again, the odds favor taking out the F period high just because of its exactness. It's only one data point, but that's what the odds are. Okay, let's continue to play. You see there was some mechanical selling automatically at that level because traders can see it. Now we've tagged it exactly. So you see it did come back there. Very easy to see. Now we've taken that out. So the market is now going to be looking at the high from the previous session. So you can see it's getting pretty stretched out. It hit stops once it got above the overnight high. We are still one time framing since the B period low. Now you got a lot of things to keep in mind, but these are really important. And when you learn to do this in relationship to the price movement, you will calm your system and you will have a substantially improved understanding of what is really going on or transpiring in the market. So far today, we have an inside day. It's a form of balance. We said when you looked at the bottom, the destination trade becomes the opposite extreme. The opposite extreme is the high from the previous day. So you had something to measure. Now, when you get up here and you get this close, the best thing to do is to take the trade off. It may take it out, but you've come from just above the previous day's low to just below the previous day's high. Don't get greedy. When it gets up there, take it off. And look how much this market has come back. And we're still one time framing higher. A lot of volatility, tremendous amount of volatility. Now that's only about a 45 handle move up there. That is a tough move. But now we have a lot of single prints. Come back down, we had another chance to have a double distribution day. We've left a lot of excess up there. The market's back at the overnight high, very mechanical level. That's a lot of rejection from the high. It's a lot of single prints. It's a lot of rejection. Remember, net, we are still within the range for the previous session. And we're going to take and change time periods very quickly. We're going to G period very quickly. Remember, we've been one time framing up from the B period low. We're now in G period. Okay, G period comes back up to the overnight high. So we're still one time framing, but notice the mechanical nature. Okay, let's stop. Okay, so the market had a potential to be a trend day up starting from the B period low. C period did not take out the B period low. D period did not take out the C period low. We went all the way to G period. G period finally took out the F period low. The odds are that the market will now be rotational since we've stopped one time framing so early in the session. Generally speaking, if you're going to have a trend day, you will not stop one time framing until later in the afternoon. There's nothing absolute about that. It's just an observation that I've made over time. Now that we have ceased one time framing in G period, the odds are that the market will do more rotation or more back and forth over the coming periods. Let's go ahead and play. That's another very important observation, and most people miss it. Most people don't see that. And we just finished an intensive prior to making this recording. And every single time one time framing ceased too early, the market went rotational during that 5-week intensive. Okay, so we have a lot of single prints at the top. We start another profile from the top, from the high. And again, we're just looking to see from the high, does the market one time frame lower? We're not saying it will, but I always start a new profile when you get a new low, and I start a new profile when you get a new high. Now that confuses people, and I'm sorry for that. But what we have, and then if it stays rotational, it's not a trend day, we merge them back together and we just We just go back to the point of looking at only one profile. So we have a lot of single prints. We did not make yesterday's high. We did not continue to one time frame, and we are now testing the lower extreme, or testing down towards the lower extreme. The first goal would be half back, and you'll see half back is right down there, the white line. So right now we have ceased one time framing. It's in G period. We're going to change time periods in about 3 minutes or so. And we want to see, do we continue to one time frame lower? So there's a lot of volatility. They've got it almost back to half back. But the first thing you notice, the sequencing, when we had that really questionable high and low. All right, so now the G period high is right around the A period high. Not it's terribly important, but it's something that you want to notice. Going to change the H period shortly. And then we're going to see if H period can get to half back or stay above half back. Not there's anything magical about half back. It's just that it's just one way to view a market. And we find that a lot of people do focus on the daytime frame half back as well as the overnight half back. Okay, so H period is within G period, which is a form of short-term balance. Lots of pressure on this market. It failed to take out the high from the 16th. Successive selling, lots of single prints. And I question if there's too many. We'll see if some of them get taken out before the day is over. One time framing ceased early. And when one time framing ceased early, that increases the odds that we will be rotational or back and forth for the remainder of the session. So notice the H period is just a couple of ticks, below half back and right at yesterday's rally high. Pretty good odds we come back through that. So as the day goes on, we're at 10 times normal speed, and the market continues to press lower. Back to overnight half back. Back, these references aren't as important once we've been through them early, but they're still there, and markets can still see them. So the H period low is exactly at the prominent point of control from overnight. It's only one data point, but again, it's mechanical and it increases the odds that we will come back through it. When you get a mechanical reference, it does two things. It decreases the odds that you get a substantial move to the upside, and it increases the odds that you come back through it. Again, what is important? It's only a single data point. Too many times people take it for an absolute rather than understand it's just a single data point. Is it relevant? Yes. Is it absolute? No. We're going to go to I period shortly. Remember, we have a question, and our question is the H period low any good? Because it went again to a very exacting level. When it goes to exacting level, that's usually an indication that who bought it there was relatively weak because they needed an exact level in order to come in and buy. And exactness increases the odds that we will come back to that level. A lot of volatility. Remember we said earlier, awful lot of single prints from once the high was made. Can we take a fast look at the high? Look at all the single prints. Just an awful lot. May be good, but with that many single prints, you would expect, if the market's really weak, you would expect to see elongation to the downside. And we always start a new profile since the high was made to see if we one time frame lower. Even though it's hard to see, so far we are. G, H made a new low, I made a new low, or I stayed within H. We are technically one time framing lower. It's just, I don't live and die by that. I just something I keep an eye on once a high or a low is made. But we said the greatest odds are that the market is rotational this afternoon. Tremendous rotation in this market. Okay, I period matched H period, took it out. So we no longer are one time framing lower. As we said, once you stop one time framing, the odds are you go rotational. And if the market does go rotational, you go back and forth. The swings are pretty wide. But that was what would be considered rotational. You have trend, which is directional. Rotational just means that the market is going back and forth, not in an exact manner and not necessarily around any particular point, but remember early on we commented that the market lacked confidence from the opening bell. It was open within the previous day's range. Market went down, it went up, it went down. So overall confidence wasn't there. The lower the confidence, the greater the odds that it is a rotational day. Now this is a difficult rotational day because of the volatility, but it hasn't been unreadable because of what the market has done around the references and around one time framing. Okay, so as we get later into the session, we are still rotational. We are still within the previous day's range. Value is, I think, slightly overlapping to a little bit lower. At least the highs are a little bit lower. Still early. One more time, the J period high is weak because it's just a tick below the overnight high. So the market, even with this kind of volatility, the market is still stopping and starting at exact references. So it went to that exact reference, traders sold it, it came back down through it. So again, we saw another return to an exacting reference. Early on, we commented that for a rotational day inside the previous day's range, was an awful lot of single F period prints. Even with all the volatility, we have come back and at least taken some of those prints out. Now we're just about halfway through J period, getting later in the session. Market remains rotational. Value remains overlapping to lower. So see the market one more time. It's, you get a lot of volatility. What happens a lot of times, short-term trading is a combination of the market getting too long, then too short, then too long, then too short. And traders make a big mistake if they try and apply investment thoughts to daytime frame trading. Our suggestion is you stand in front of the mirror every morning and remind yourself that you are a daytime frame trader, not an investor. They are totally different mindsets. Today, we suggested today would be choppy and rotational from the beginning, which it has been. Okay, we took out some of those single prints. They looked like they were excessive to begin with. And if nothing else, when you have that many F single prints to begin with, the market should have gone, if they were really, valid, the market should have gone all the way down and extended on the other side. When it didn't do that, it just was an indication that the F period selling just a little bit too aggressive by weaker hands traders coming from relatively, just shy of the previous day's range. Okay, so we're going to change time periods just a fraction of a minute. We are still within the previous day's range, still choppy. And, yesterday's or last night's overnight high, it's going to be support. Nothing major. It's just, why is it important? Just because it's something traders can see. Traders tend to go to levels they can see or understand. They can understand the morning high. They can understand the morning low. They understand half back from overnight. They understand half back from today. All right. So K period, pushing up, taking more of those single prints out. And let's see how far the K period high is from the daily high. Okay. It's within striking distance, but it hasn't done it. Remember, we're playing at, 10 times regular speed. Let's go take this up to about 20 times as we look at the final portion of the day. So now we're going at a pretty fast rate of speed. It's 10 times the normal speed. We did not take out the high. It doesn't take out the high. And we said earlier, support would be, there you go, support was at the overnight high because it's easy to see and visible. So we had chop early on. The market has now found its point of control. Another word for point of control is fairest price at which business is being conducted. So we had chop and rotation early on. We have chop and rotation now with just about I think we've got about an hour left. Hour and a half.
Yes.
Okay, and remember, once the market ceased one time framing higher from the original B period low, we said the odds are that the market would be rotational, which it has been. Most people miss those little clues. They're extremely important. Okay, so we're selling off an L period. The next lower reference, of course, would be half back because it's very easy to see. Heavy rotation. Remember, the trend has been down for the last, couple of weeks. The market has been rotational today once it's ceased one time framing from the B period low. Volatile, yes, but it's done pretty much what we have suggested throughout the intensive markets will do. There's always exceptions, but you need to have some understanding. And remember, our whole goal here, when we go through something like this, is to help you appreciate the importance of being able to relate price movement to what is going on at these different references. What's going on at these different references gives you a pretty good clue what those that are trying to take your money or those people you're competing against, what are they doing? And when they are acting and reacting mostly from fairly exacting references, guess what? They're mostly short-term, daytime frame traders. And they get very emotional. But, if it was everybody saw it's just long-term money, it's a trend day. No, the fact that the market went rotational says basically we've got a lot of short-term money. At the floor, even though volatility wasn't as high, we used to say there's a lot of short-term traders picking each other's pocket. Okay? So the market one more time trying to make a run towards the highs and run towards those single prints. Tremendous volatility today. But when you go through all this volatility, remember, there's been no real change relative to the day before. We are still within the same range from the previous session. If you're not focused on the right information, you lose track of that. Once you understand we're probably still within the previous day's range, it makes it much easier to trade. You're not looking for home runs as much as you're looking for, a lot of stopping and starting, because that's really what rotation means. So we get late in the day, the market makes another run at the F period single prints and the F period high. It fails again. It failed early, failed again, did not take that high. And now you're right back near the overnight high. And we said the overnight high, because it's easy to see, it is a form of support. It's a good support? No, but it's easy to see and recognize. All right, so we've come back. We tried to take the high. We didn't. That still leaves us within the previous day's range. Remember, the trend is down. The trend's been down for the last few weeks. And generally speaking, you would prefer to be trading with the direction of the trend. Okay, where are we right now? Are we closed?
Yes.
Okay, so let's just do a fast review. Overall purpose is to help you get to the point where mentally you can constantly relate price to the references. The more exacting a market trades at the references, the greater the odds that you are dealing with other short-term traders. Long-term traders, they don't know where those references are. They don't know where half back the opening, and it's extremely important to know who you are competing against. We opened within the previous day's range. We opened within the previous day's range. We said the odds are we would have chop. Chop means the market will go back and forth. Remember, the market went down, it went up. We got chop all day long. If you don't understand this, you have a tendency to carry a very high emotional level and make some silly mistakes. If you understand what's expected, kind of day it is, it's much easier to stay in touch with the day. B period went down, took out the overnight low, but failed to take out yesterday's low, and then B period left single prints. So starting from the low in B period, the market began to one time frame higher. And we said if there's anything really meaningful on a trend day, the market will generally not cease one time framing until very late in the session. And it makes that cessation late in the session to allow short-term inventory to come back into balance. Then the market makes another run in the direction of the original trend. Today, the market stopped one time framing in, was it G period? And when the
Yes.
market stopped one time framing that early, that is an indication that we're going to remain rotational. As we said, we just finished a 5-week intensive. And every single time we made that observation during that 5-week intensive, the market did go rotational. Does it have to? No. Can things change? Of course. But it's a pretty good sample size. And I've been watching this for a period of time. So the market stayed pretty much rotational the remainder of the session. Value was, I think by the time the day was over, value was just about unchanged relative to yesterday. So today, the form, or the day we're trading, is a form of short-term balance. Short-term balance means it's an inside day relative to the previous session. Now we have guidelines for trading value, or trading balance, or inside days. You either remain within balance, or you break out of balance in either direction. Or if you break out of balance in either direction and fail, the destination trade becomes the opposite extreme. So as we look and prepare scenarios for the following session, we would start and say, okay, scenario one, the market remains within the range of the past 2 days. The market would remain within short-term balance. Market breaks to the upside would be positive. Market breaks to the downside would be negative. Or the market breaks to the upside, fails to continue, comes back in, then the destination trade becomes the opposite extreme. Or just the opposite, the market takes out the low, fails to carry forward or carry lower, comes back in to the range, and then increases the odds that we'll trade to the opposite extreme. They're just odds, but it gives us a way to keep perspective about what is really going on. And today, as we watch today, from the opening bell, it spelled balance. Yes, a lot of volatility, simply because volatility has been very high. But when you get all said and done, no matter what price did, there was no real change in this market. Thank you.